Good evening, students. If you have any questions relating to the previous class, Namita, you have certain questions. 195 the payer is Anna. How will he deduct TDS? He has to obtain PAN. That's very logical. Namita already answered it. For long-term bond, PAN is not required. You are correct. Okay. So what we are going to do now is we are going to start with the penalties only. We will finish off few penalties what we had not done in the last class, and then we will be proceeding towards the miscellaneous topics, which is going to be prosecution and few other set of topics which I'm going to discuss with you, and that will complete your entire module for this, right? Okay, so what we had done in the last class was we were talking about the TDS penalties, right? We were discussing about the TDS penalties, isn't it? Now, few other penalties which I would like to discuss with you, which is in relation to the maintenance of books of accounts, audit, and all of that. So, one such penalty is which is mentioned in the 271A, which is is failure to keep or maintain the books of accounts as required under 44A. So if you fail to maintain books of accounts or documents as per 44A, then in that case, what will happen? You will have a penalty under section 271A, which is rupees 25,000. Which is rupees 25,000. Is that clear? So the penalty is rupees 25,000. Clear? Then the second penalty is in relation to the transfer pricing documentation, which is specifically for the transfer pricing documentation. So which I'm not writing it here, I'm considering separately because there are certain TP documentation or failure to report the transaction. Failure to report the transaction which the assessee is required to report, or furnishing the incorrect information. Failure to report. Here something more should strike you. Let me see who answers it. There is one more penalty in relation to this. We have already dealt with that. Let me see who answers. Furnishing incorrect information. Right? So the penalty in this case is going to be 2% of the value of international transaction. 2% of value of international transaction or specified domestic transaction. Is that clear? But here one more penalty is there. Let me see who answers this. We have dealt with it, right? Very quickly, let me see. Anyone remembers? We had dealt in the last class only. Which one was that? Let me see who is saying. Nobody? Okay. So if you remember, which you don't as of now because you have not revised correctly, there was the case of misreporting of income. You have forgotten, right? There was a case of misreporting of income. We have done that. 200% of tax, which is the penalty under section 270A, which is failure to report international transaction or deemed international transaction or specified domestic transaction. So if you fail to report international transaction or the specified domestic transaction, it will be considered as misreporting of income. So in this case, failure to report transaction will not only attract penalty under 271AA, this is in addition to 270A, plus there will be penalty under section 270A for misreporting of income. Is that clear? Is that clear? Now you remember? So there will be, in addition to that, there will be a penalty of misreporting if you fail to report the international transaction. Clear? Is that all right? Next particular penalty is failure to get accounts, which is under 271B. Failure to get accounts audited or obtain audit report under section 44AB. So if you fail to get your books of accounts audited or furnish the audit report, then the penalty is going to be 0.5% of your sales, 0.5% of your total sales or turnover or gross receipts of your business or profession, or rupees 1.5 lakh, whichever is less. So lower of 0.5% of your sales or rupees 1.5 lakhs, whichever is less. Is that clear? Namita, it was 200% because it is considered as misreporting and not underreporting. Is that clear? Then, if you fail to furnish TP audit report, if you fail to furnish the TP audit report, right, then it is going to be, the penalty is going to be rupees 1 lakh. So failure to furnish the TP audit report under section 92E will be rupees 1 lakh. So again, this is a very TP specific penalty, which I have written separately for you, right? So if you break it this way, it will help you in remembering the penalties. Is that clear? It will help you in remembering the penalties. So first under TP is failure to maintain the TP documentation or failure to report the transaction, international transaction, or furnishing incorrect information, or even for that matter, failure to furnish the information called for under by transfer pricing officer, all that will be 2%. of the value of the international or specified domestic transaction. Is that clear? So here even one more you can write. Failure to furnish transfer pricing information called by TPO. Clear? Next TP specific penalty which is there is in respect of country by country reporting. So not furnishing of, we will learn what is country by country reporting when we will go to the transfer pricing class. But for now, remember this penalty. That time also we will again refer back to this. So non-furnishing of country by country reporting, CBCR which is called. Then if the period of delay is less than 1 month, if the delay is less than 1 month, then in that case, the penalty will be rupees 5,000. Penalty will be rupees 5,000. If the delay is beyond 1 month, then it is 15,000, and this is, remember, 5,000 per day. The penalty is 5,000 per day and 15,000 per day. So if it delay is less than 1 month, then it is 5,000 per day, and this is delay beyond 1 month, 15,000 per day for the period exceeding the 1 month. And if there is a continuing default, even after the TPO serves the order levying the penalty, then it is going to be 50,000 per day of continuing failure. So if there is continuing default, then 50K per day, even after service of notice of penalty. Is that clear? Then if you fail to produce the information before the authorities, then also it is going to be 5,000 per day from the day following the day on which the period for furnishing the information expires. And if there is again continuing default even after service of penalty order, then also it is 50,000 per day. If you fail to produce, the information before prescribed authority, then 5,000. And again, continuing default is say 50,000. Clear? If you furnish the inaccurate information, so inaccurate CBCR, the penalty is very high, which is rupees 5 lakh. Is that clear? So if the entity has the knowledge of the inaccuracy at the time of furnishing the CBCR but does not inform the authority, or if it discovers but still does not correct within the 15 days of discovery, if the entity furnishes incorrect information to the notice as a response to the notice, then the penalty is going to be 5 lakhs. This is under section 271GA. This is under section 271GA and GB. Is that clear? This is under section 271GA and GB. And this was under section 271BA. Is that clear? So this CBCR has very, very hefty penalties. Clear? Is that clear? Okay. Any doubt? Okay. Now balance are very small penalties and miscellaneous penalties which we are going to talk about. So we have covered the penalties into different segments so that you can remember whenever you are revising it, right? So we have done it for TDS, we have done it for compliance penalties now, for the documentation purposes, then for TP documentation also we have done it. Now balance are again some compliance penalties which I'm going to talk about now is, so few compliance penalties again. So one is the failure to furnish the statement of financial transaction. If you remember, we had done it, what is statement of financial transaction already when we were dealing with the assessment procedure, right? If you remember, the financial institutions, they have to furnish the information to the income tax department regarding some financial transactions which are taking place, purchase of immobile property, opening up of accounts, cash deposits, cash withdrawals, mutual funds, purchase of shares. Remember all of that. So they have to furnish the information by which the income tax department comes to know of high value transaction taking place. So if any prescribed institution which has to furnish the statement of financial transaction, they fail to furnish, so failure to furnish statement of financial transaction, the penalty is under 271 FA. And the penalty is rupees 500 for every day. $500 per day. So we had done that, right? Under 285 section, if you remember, we had already done that, which was the furnishing of the statement of financial transaction. You can also find that particular section under your miscellaneous chapter in the module. So it is 285 BA section, which we had done that there are different institutions which are specified, which are required to furnish a statement of financial transaction. So if they have been receiving certain transactions, then they are required to do that. Which are the prescribed institutions? They could be the registrars, they could be the postmaster general, they could be the recognized stock exchanges, banks, financial institutions. So all these are required to report the transaction which is in relation to providing any goods or services, purchase or sale of securities, taking any loans, any investment made or expenditure. And this statement of financial transaction, remember just one thing, has to be furnished in form 61A. And this has to be furnished by 31st May, immediately following the financial year in which the transaction is done. So this has to be done by 31st May of following financial year. If you fail to do that, there will be penalty of rupees 500 per day. Is that clear? So if you fail to do that, there will be penalty of rupees 500 per day. Clear? So this is one penalty with respect to the statement of financial transaction, which is under 271 FA. Clear? So a penalty of 500 per day, during which the failure continues. And failure to furnish the statement of financial transaction, within the time if the notice is given. So quite possible that the income tax authority gives you a notice to furnish it, right? So when a person is required to furnish the statement of financial transaction and he is not furnished, the income tax authority may serve a notice on the person requiring him to furnish the statement within, say, a 30-day period of serving of notice. And even if he still not furnishes, so failure to furnish after notice, then your penalty is rupees 1,000 per day. Then you have a higher penalty of 1,000 per day. And if you furnish incorrect statement of financial transaction, then the penalty is going to be 50,000. Then the penalty is going to be 50,000. Is that clear? So these are the penalties for the statement of financial transaction. Clear? Any doubt? Any doubt till now? So this is under 285BA. The statement of financial transaction has to be furnished. Clear? Now balance few penalties are again in relation to some sections where the information is required to be furnished. For example, under section 9A. 9A section is there which requires the certain fund managers activity which do not constitute the business connection in India, which is for the fund managers basically. Section 9A, which is there. So for them also, there is a penalty if they do not furnish the information there. They are required to furnish certain information under 9A section. And if they do not furnish this information, then they have a penalty of rupees 5 lakh. So failure to furnish the information or a statement which is required under section 9A. So 9A is basically for the fund managers, that the fund managers of the foreign funds will not constitute the business connection in India. And these investment funds basically have to furnish a statement containing the information regarding their fulfilling the conditions, because they will not constitute business connection based on the fulfillment of certain conditions. You will learn that when you will be dealing when you will be doing your international tax class. So if they do not furnish information, for them also there is a penalty. The penalty is rupees 5 lakh. The penalty is basically rupees 5 lakh. Clear? So that is one penalty which is there for the 9A. I'm just writing it over here. Furnish statement under section 9A, rupees 5 lakh. Is that clear? Then there is one more section which is particularly for the indirect transfer. Again, what is indirect transfer? You will learn in your international tax class. So time being, I'm just giving you the penalties because that will help you revising it. So there also the Indian company has to furnish the statement. Furnish statement of indirect transfer under section 285A. So under section 285A, the company has to furnish this statement, and for that the penalty is 2% of the value of transaction. 2% of the value of transaction. Is that clear? So there are two penalties basically. One is 2% of value of transaction if 2% of the value of transaction if The transaction has the result of transferring the right of management. If there is transfer of right of management or control, else the penalty is rupees 5 lakh. Is that clear? Else the penalty is going to be rupees 5 lakh. Clear? Further, there is one more penalty which is again little bit important, which is under 271G, which is not on assessee but on the professionals who are submitting the incorrect reports or certificates. So the accountant, merchant bankers, or the registered valuers, if they are furnishing incorrect reports. So chartered accountants, if they are furnishing incorrect information in reports or they are furnishing incorrect certificates, then 10,000 is the penalty. 10,000 is the penalty for each certificate or for each report. Is that clear? So 10,000 is the penalty. Clear? This is for the chartered accountants. There is one more penalty which is newly introduced, which is for the research association, universities which are allowed the scientific research, for which you get the scientific research deduction, right, under section 35. Now, these particular research institutions or universities are required to give a statement that they are fulfilling certain conditions. Now, if they fail to give these statements, then they are also required to give the statements of the donations received, right? So if they are failing to do that, then it is 10,000 to 1 lakh is the penalty. So scientific research institution or universities, right? Scientific research institutions, university, colleges, which are referred to in under section 35. Now, if they fail to deliver the statements under section 35, they are required to give the statement, or they are required to furnish the certificates also which are prescribed under 35. If they fail to do so, the penalty is going to be from 10,000 to up to rupees 1 lakh. Is that clear? Or if they fail to deliver a statement under section 80G or furnish the certificate under section 80G, they have the same penalty of 10,000 to 1 lakh. Clear? Is that clear? $10,000 to 1 lakh is the penalty. Any doubt till now? Namita, if the CA certificate is wrong, as in if he gives the wrong information, means that is wrong, right? Is that clear? If he provides any wrong information, reporting any wrong point, if he says that there is no tax which is required to be deducted, but tax was required to be deducted, it happens under section 195 especially, where you are required to put the remittance certificate, where the CA is required to issue the 15 CB form. Then quite possible that he has given the wrong information, and for all that he could be penalized, which is rupees 10,000 per certificate. Is that clear? Understood? Okay. So as I said, for the research institutions, they are required to furnish the statements. For example, they are required to furnish the certificate specifying the amount of the donations. They are required to give that. And if they fail to do that, then they are liable for penalty, which is 10,000 to 1 lakh. Clear? 10,000 to 1 lakh is the penalty for them. Any doubt? Okay. Let's proceed further then. Then few other penalties where the person refuses to answer any questions given by put forth by the tax officer, or he refuses to comply with the summons issued under 131 to give the books of accounts or produce books of accounts, or he fails to comply with the notice issued under 143.1 or 143.2, 142.1, then the penalty is going to be 10,000. So, failure to produce books of accounts or refusal to answer questions or non-compliance with summons or notice under section 143.2 or 142.1 or audits, then it is going to be, the penalty is going to be 10,000. The penalty is going to be 10,000. Is that clear? Clear? Okay. Similarly, if the assessee fails to comply with section 133B, if the assessee fails to comply with the provisions of section 133B, where the income tax officer is collecting the information, then it is 1,000. So, failure to comply with 133B section, it is rupees 1,000. Failure to quote the Aadhaar or failure to comply with the Aadhaar requirement. So, failure to quote Aadhaar or not obtaining, then it is again 10,000. So, failure to quote Aadhaar in the documents, right? Or failure to ensure that the Aadhaar is duly quoted by the person who is obtaining also Aadhaar, then it is 10,000. Is that clear? Any doubt till now? So these are the penalties which we have covered. I've covered all the penalties and I've broken into different parts, right? Now, one more thing. If you do not have any doubts, let me move ahead. Okay. So one more thing is the immunity from the penalties. Now, what are the immunities from the penalty and prosecution? Now, there is this section (270AA). What does this say? So, assessee may make an application. So, here the assessee has to make an application to the assessing officer. So, if the assessee feels that the penalty should not be imposed on him, if the assessee feels that the penalty should not be imposed on him, then he can request for the immunity from the penalty under 271AA, under 271AA, there is immunity from the penalty available. There is also a section under 273AA, and there is immunity from the prosecution available under 278AB. Now we will learn all three together. Let's try and understand first 270AA, 270AA. Now here the authority is the assessing officer. So assessee can make an application to the assessing officer for grant of immunity from the imposition of penalty under. So here immunity from is 270A, which was under-reporting and misreporting, or the initiation of proceedings under 276CC. 276CC is for the prosecution, which we are going to talk about in a while. Prosecution is what? Prosecution is jail. So 276CC also is covered and 270A is also covered here. So immunity from 270A, 276CC, which is 276CC is in the case of failure to furnish the returns of the income. So for that, there is a prosecution. So 270AA is the application before the AO for immunity from 270A and 276CC. And what are the conditions? So the first condition is that the assessee pays tax plus interest as per the assessment or reassessment order within the time specified in the notice of demand. So assessee pays tax and interest as per section 143.3 or 147 within time given under section 156, which is your notice of demand. Clear? So assessee pays the tax as per the assessment or reassessment order within the time specified in the notice of demand. The second condition is assessee does not prefer appeal. So the first condition is pays the tax plus interest, and the second condition is that the assessee doesn't prefer the appeal against such assessment or reassessment order. And finally, the assessee has to make the application before the AO within 1 month, within the period of 1 month from the end of the month in which assessment or reassessment order is received. So within 1 month itself, the assessee needs to make the application. So the time limit for making application is 1 month from the end of the month in which the order of assessment is received. Is that clear? And then if the AO is satisfied on the fulfillment of the conditions and the time limit for appeal has also expired, the AO can grant the immunity under section 270AA. The AO can grant the penalty under section 270AA. And the time limit for AO is time limit for immunity order is going to be 1 month from end of the month in which the application is received. Application is received from the assessee. And if the AO wants to reject this immunity, then he has to give the opportunity of being heard to the assessee. However, AO will not grant the immunity. AO will not grant the immunity in cases where the penalty under section 270A is on account of misreporting. So remember this thing very clearly. So no immunity if penalty under section 270A is on account of misreporting of income. So again, this is one of the important condition only, that there should not be penalty on account of misreporting of the income. Is that clear? Now this order of the AO is not appealable before the Commissioner appeals. So this order of AO is final and not appealable before the CITA or a revision under section 264. So this order of the AO shall be final. It cannot be taken up for revision also, or there is no appeal possible. Is that clear? Is that clear? Any doubt? Namita, accountant is defined under the Act under section 288. Clear? So this is about section 270AA. We have done about 270AA. Now, what about 273AA? Right? 273AA. Now for 273AA, again there is possibility of the waiver. 273A, there is a possibility of waiver, but sorry, 273A. It's not A, it's A. Now here, under 273A, who is the authority? Here it is PCIT. Here it is going to be PCIT or CIT. PCIT or CIT. If the assessee makes the application, the PCIT or the CIT has the power to waive the penalty imposed under section 270A. Is that clear? So it is also under 270A. Now what are the conditions over here? Here the reduction or the waiver will be granted if prior to the detection of the concealment of income by the AO, the assessee has made the full and true disclosure of all the income voluntarily and in good faith. So here the condition is that the assessee prior to the concealment of income has made disclosure voluntarily and in good faith. So prior to the detection of the concealment of the income, prior to the detection of concealment of income by the AO, the assessee has himself made the full and true disclosure, voluntarily and in good faith. Is that clear? Is that clear? He has cooperated assessee has cooperated with the department in any inquiry relating to the assessment. So, assessee has cooperated in the assessment. The assessee should have paid the tax or interest. Paid tax or interest as per the assessment order. So, assessee should have paid the tax or interest in the assessment order. Is that clear? And if it is a penalty at 270A, if it is a penalty under 270A for underreporting, then the amount of income, if it exceeds rupees 5 lakh, then the approval of the Chief Commissioner or Principal Director General or Director General needs to be obtained. So if penalty under section 270A and income greater than rupees 5 lakh, then approval of higher authorities required. Clear? Now understand one thing very clearly. The Principal Commissioner will exercise this power after recording the reasons, right? And is also empowered to stay the proceedings also for the recovery of penalty. In case if he feels that it is going to cause hardship to the assessee has cooperated, right? So in that case, the Principal Commissioner or the Commissioner can stay the proceedings also. But here remember one thing, this relief which is there is available once in lifetime. So this is once in lifetime opportunity which the assessee gets. So once under 273A, the assessee obtains the order, again he cannot ever apply under 273A for any other assessment year. Also here one more thing, if there is other penalty and if the income exceeds 1 lakh, if there is other penalty and the penalty also exceeds rupees 1 lakh, then also higher authorities approval required. Clear? Again, this order is final and this cannot be challenged before any court. So order is final and cannot be challenged in any court. So this is a final order and it cannot be challenged before any court. Clear? Namita, yes, appeal is available, but the assessee will not go for the appeal. That's what they mean. Is that clear? Clear? Any doubt? Did you understand immunity from penalty? Any question, any doubt? Okay, let's proceed further. Similarly, 278 AB is for the prosecution. So we are not dealing with that, but I'm just telling you that this was the immunity from the prosecution. Because this is not part of your module, but 278 AB is also there, which is again an application to the principal commissioner for granting the immunity from the prosecution. And that was more from the settlement commission perspective, that if they had gone into settlement and that particular proceedings had abated. But now there is no settlement commission, so that is not to be done much. Is that clear? Now, one more thing before we wind up this chapter is the procedure for the assessment of penalties. So, for the assessment of the penalty, where the penalty is exceeding 10,000 rupees, then the income tax officer can pass the penalty order. If the penalty is exceeding 20,000, then Assistant Commissioner ACIT or DCIT is empowered to pass the penalty order. Is that clear? Again, now there is going to be a faceless scheme of the penalty also. There is going to be a faceless penalty. Clear? Is that clear? Any doubts before we close this chapter? So we are done with the penalties chapter completely. If you have any questions, otherwise we can just take up few questions from the module and then move towards the prosecution. Any doubt? Namita, the time limit here is 12 months. Time limit here is, time limit for the order is 12 months from end of month in which application is received. So it is 12 months from the end of the month in which the application is received for 273A. So they have to pass the order within the period of 12 months from the end of the month in which the application is received by the PCIT or CIT. Is that clear? Any doubt? Okay. So let's discuss few questions before we close this chapter. Akshay, did you understand the time limit? Okay. So let me just take you to the questions which you need to answer. So this is a question on the screen. X, an individual whose total sales in the business of food grains for the year ending 31st March 22 was 205 lakhs, did not maintain the books of accounts even though his turnover was 28 lakhs. During the previous year, majority of payments were made either in cash or by bearer check. The AO has levied the penalty of 25,000 under 271A for non-maintenance of books of accounts and penalty of rupees 1 lakh 2 under 271B for not getting the books of accounts audited as per 44AB. Is the AO justified in levying the penalty under section 271B? That's your question. Quickly tell me the answers. Quickly tell me. What will be the answer? Yes, Naveen, correct. Geeta, the procedure is going to be the same only. It is going to be through the assessment procedure only. Naveen, yes, you are correct. Namita, the appeal is available means that the appeal has not been filed by the assessee. The assessee does not go into appeal. If the assessee goes in appeal, he cannot take an immunity from the imposition of penalty under section 270AA. That's the point. Is that clear? Okay, understand one thing very carefully now about this particular question. Here, the Mr. X, which is there, he is required to maintain the books of accounts because his turnover has exceeded already 25 lakhs as per 44A. And his gross sales, if you see, his sales from the food grain business is 205 lakhs. Now, since it is exceeding 1 CR, he was required to get the books of accounts audited also. He has not maintained the books of accounts. He has not got the books of accounts audited. So he is first of all liable to pay penalty under 271A for not maintaining the books of accounts. So yes, the levy of penalty under section 271A by the assessing officer is very correct, because as I said, if you do not maintain your books of accounts, then you are liable for penalty, which is 25,000, which is correct. But now, if the books of accounts are not maintained only, where is the question of getting them audited? So if the books are not maintained at the first place, there is no question of getting them audited. So for auditing, there has to be first the maintenance of books of account. When X is admitting that he has not maintained the books of accounts, there is no question of getting him audited. So Guwahati High Court in one of the case had held that where the person is not maintaining the books of accounts, then yes, there is an offense for which the penalty is there under 271A. But there cannot be any other possibility of getting them audited because he is not maintained only. Therefore, the penalty under section 271B was held to be not justified where the person has not maintained the books of accounts only. So the levy for the not getting the books of accounts audited by the AO under 271B is not justified in this particular case. Is that clear? Clear? Any doubt? Any doubt? Is that clear? Okay, shall we move on to the next question then? Next question is question number 5, which is in relation to an assessee who had credited a sum of rupees 50,000 in cash in the account of Mr. Madan, said to represent a loan obtained from him. The AO, having gone into the genuineness of the transaction, disbelieved the story of loan and treated 50,000 as the income of assessee from undisclosed sources. He also started proceedings under 271D and levied a penalty of rupees 60,000 on the assessee for having accepted the loan in contravention of 269 SS. Examine the correctness of the levy. So you tell me whether the AO is correct in levying the penalty. Namita, did you understand the earlier question? Namita, 270 AA says that the order of the AO is final. An appeal is not available against that order of AO. Which order of AO? The order of AO rejecting the immunity or granting the immunity. Against that, there is no appeal possible before the CITA. But against the assessment order, there is always appeal available. If the assessee wants to go in appeal, he cannot obtain immunity. If he obtains immunity, if he doesn't get immunity, or even if he gets immunity, say for example, if the AO reduces the penalty, he doesn't completely waive it off, then in that case, he cannot appeal against before CITA because that order of AO will become final. So appeal is not available against that immunity order. Is that clear? Yes, Akshay, you are correct. Where 271A is applied, then there is no point of 271B penalty with kicking in there. What about this question? Yes, you are correct, Geeta. That is one aspect, but there is also one more aspect here. There is one more aspect over here. Naveen, yes, again, that's one more, but there's one more aspect here. That's the correct answer, but there's one more aspect. Namita, no, not the correct answer. No, Namita. Yes, Akshay, correct. But okay, let's discuss a very important aspect over here. Now, first of all, if you notice, the AO has levied the penalty under section 271D of rupees 60,000. So what we had learned while we were dealing with 271D, if you remember, under 271D, if I take you to the 271D section, so 271D, how much was the penalty allowed? Sum equal to the loan or deposit. Penalty under section 271D was sum equal to the loan or deposit. In this case, the AO has levied the penalty of 60,000, whereas the sum was only 50,000. So the maximum penalty would be only the sum equal to the loan, which is 50,000 only. Secondly, the important point which all of you missed here was, so what I had written over here, penalty is to be imposed only by JCIT. Here the penalty is imposed by the assessing officer, which is incorrect. It has to be only by the JCIT. Therefore, this penalty is completely invalid. Third aspect. The AO is saying this is the undisclosed income. This is the undisclosed income. The AO himself is saying this is the undisclosed income. And on the other hand, once he has said that this is an undisclosed income, it is not a loan. Either it can be a loan or it can be an income. It cannot be both. So once he has said it, that this particular amount is undisclosed income, how can he again treat it as loan under 269 SS? Because once he himself said that this is undisclosed income, it ceases to be the character of the loan. And therefore, one of the fundamental principles for levying penalty under 271D is that there should have been a loan, which is not the case here. So therefore, this penalty is invalid on all these grounds. Is that clear? Yes, Priya, very correct. Yes, Veela, perfectly. JCIT has to impose this penalty. Is that clear? Clear? So shall we just close this chapter and then we move towards the prosecution? If you have any doubt, you can ask me. Or do you want to do one more question on 278, or is it very clear? Because 278 we had done several questions in the last class also. If you want to do one more, that is also fine with me, but you have to give me very quick answers, else we can just move towards the prosecution chapter. What do you want to do? Quickly in the chat box. See, one more thing I want to tell you is, you would be having a certainly a question, ma'am. How do we remember this penalties chapter? There are so many penalties, right? You will be having this question very clearly, right? So see, I would tell you, remember the most important ones. Of course, for MCQ, anything from this chapter can come up. But that is beyond your control also. Remember that thing. You cannot keep everything. So you don't have to remember each and every penalty because you will not be able to do that. That is very clear. Yes, perfectly fine. We will go to the next chapter. 270A is clear for everyone. Okay. If you want, you can always do question number 8, which is at the end of the module. But what I was telling is that you don't have to remember all these penalties. What you have to clearly remember is, without any iota of doubt, is that you need to do misreporting and underreporting. That is very much clear. Second, for the search cases, for the transfer pricing cases, and for the maintenance of books of accounts, audit report, all that. These 4 segments you have to do it. There is no doubt about it. The rest, what you can be doing is, for example, if a question comes up on TDS, you can just say that there is a penalty also. Under which section you may remember, you may not. Even if you don't remember, if you just quote that there is a penalty also for this, that is all right. Even if you don't write the proper amount, there is no point writing a wrong answer than not writing that point itself. So don't write wrong answers. Just say that yes, there exists a penalty for non-furnishing of TDS statements. So that is how you can do it. But the most important one, as I said, is for the concealment of income, which was 271 and 270A. Then for 269, 271D also, for 269 SS, 269D, all these you have to remember for the concealment of income for cash transactions. Rest for the transfer pricing also, you can just choose to remember for the transfer pricing documentation, transfer pricing audit report, 44AA, 44AB. That's it. These you should be clearly remembering. Rest you can just remember that there are penalties for these offenses, and that should be fine. Is that clear? Okay, let's move ahead then to the next chapter, which is prosecution. Now, what is exactly prosecution? Prosecution is nothing but that offense for which you can go behind bars. So that is your prosecution. Now, for the prosecution, there are different offenses prescribed under the Act. And what are those prosecution of the offenses? Let me just take you through the module only. So, first is, let me do one thing. First is section 275A, which is for 132, contravention of the order under section 132. Now, 132 was for your search cases. 132 was for your search cases, right? If you do not comply with these search orders, what does 132.1 and 132.3 talks about? So if you remember under 132, we had a provision that any person to whom the notices or summons are issued will have to produce the books of accounts, right? Or if he is in the possession of the jewelry, then in that case he does not have to part with that jewelry, right? So under 132.1 plus under 132.3, under 132.1 also the income tax officer, or basically the officer who is conducting search, can enter the building. He can break the door, right? He can seize any books of accounts. He can place the identification marks. And the other person has to allow him in whose premises the search are conducted. Similar was in 132(3), where the person who was having the possession or control of the documents, money, bullion, jewelry, he shall not remove it or part with it, right? So in that case, if you do not comply with those orders, then there is going to be a prosecution, which is rigorous imprisonment of 2 years plus fine. And the quantum of fine is not defined. Similarly, where there is a failure to afford the authorized officer to inspect the books of accounts, where there is failure to afford the necessary opportunity to inspect the books of accounts for the authorized officer, then the prosecution is again up to 2 years plus fine. Removal, concealment to thwart tax recovery, again it is 2 years plus fine. Then 276A is with the liquidation officer. Failure to comply with the 178 section regarding company liquidation, or while the company is in liquidation, that time if the officer is not basically complying with section 178, or he parts away the assets which are there in the liquidation. So 178 is basically for the liquidation of the company. What does 178 talks about? 178 is basically dealing with the liquidation of the company, and it says that the liquidator who is there, or the receiver which is appointed, has to give the notice of appointment to the assessing officer. If he does not do that, or he part with any assets of the company without telling the principal commissioner of income tax, then in that case, this is on the liquidator and not on the assessee. He has the imprisonment of 6 months to 2 years. Then, so these you can remember. For the search, you can remember that there is a rigorous imprisonment of 2 years if you do not afford the opportunity. This you may not necessarily be remembering. This again, not necessarily you might be remembering. Again, this 276AB is also for the immovable property transfer. 276B is, you can again remember, failure to pay the central government the TDS. So for TDS, remember one thing, when there is a case, there are these case study type questions which are asked in TDS. So whenever you get any question, and if, say for example, the case study mentions that the assessee has not deducted, or he has failed to pay the tax which is deducted by him, then what you can be writing is, you can be saying that yes, of course, there is first of all going to be, the assessee is going to be treated as assessee in default, which is under 221. Then you will be writing that there will be interest on him, 1%, 1.5% for late deduction, late payment. You will also be writing then about if the payee has filed the return of income, included this income, and has obtained the certificate from accountant, then the assessee, the payer, will not be treated as assessee in default, right? But the interest still will be leviable on him. That also point you can mention. The fourth point which you can mention is that there will also be the penalties. So penalty is going to be equivalent to the TDS amount. So you don't need to use much of your head to remember whether it was 10,000, it was 25,000 or 1 lakh, whatever. You can just say that yes, if you fail to deduct the TDS, or even if you fail to pay the TDS, for failing to pay the TCS, there is no penalty. But for failure to pay the TDS, there is a penalty of the TDS equivalent amount. And it has to be only levied by Joint Commissioner of Income Tax. Plus, there is going to be the prosecution also on the company, which is 3 months to 7 years. Again, no worry if you can't remember what is the duration of the prosecution. It is just enough if you say that there exists a prosecution. Similarly, it is for TCS also. Similarly, it is for TCS also. Now for the company, if the assessee is a company who has failed to deduct the TDS or TCS, and if there is prosecution, can a company be prosecuted? Can a company go to jail? The answer is no. A company cannot be taken to jail. Similarly, it is for the partnership firm. A partnership firm cannot be taken to jail. Alright. So for a company, it is the director, manager, or the secretary of the company who can be prosecuted. For a firm, it is the partner. For AOP, it is the members. For HUF, it can be Karta. Is that clear? So, company cannot be prosecuted. Remember one thing very clearly. The directors are going to be liable for that. Is that clear? So, for TDS and TCS, you have to remember that there exists a prosecution. So, if you want, you can just write down in your chart here plus prosecution 3 months to 7 years for both of them. So that when you are doing the chart, you remember this. Is that clear? Any doubt? Yes, Akshay, imprisonment is in addition to the penalty. Is that clear? Okay. Next is the prosecution is in relation to the willful attempt to evade tax, penalty, or interest, or underreporting of income. Again, this you should be remembering. This is very, very important whenever you are writing the answers of underreporting of income. You have to remember where the underreported income exceeds rupees 25 lakh, there is a prosecution of 6 months to 7 years. And in other cases, if it is not underreporting of income, then it is 3 months to 2 years. If there are other cases of willful attempt to evade the payment of taxes, it is 3 months to 2 years. So where it is underreporting of income which exceeds rupees 25 lakh, there is going to be a prosecution of 6 months to 7 years. Remember one thing, this particular provision, because this is going to be very, very important. Is that clear? Then willful failure to furnish the return of income. If you fail to furnish the return of income in time, then not only there is going to be a penalty, but there is also going to be a prosecution of 6 months to 7 years. Again, you can just remember, you may not remember the entire prosecution time frame, but you can just remember that there exists a prosecution. There exists a prosecution. That's what you have to remember. Is that clear? So if you fail to furnish the return of income, then in that case, there is going to be a prosecution. Clear? Any doubt? So when you do not furnish the return of income, you have to say that these are the interest under section 234A will get levied. Plus, you can also have the prosecution. Is that clear? So that's what you need to write. And if the return is furnished, so remember this thing, this penalty is very, very important. So let me just show you the breakup. You can first write for the underreporting of income also in this chart itself. You can write here prosecution if (6 months to 7 years) in other cases of concealment, it is 3 months to 2 years. Is that clear? You can just write that. And then for the return of income, so it is under section 276cc. So if what is the prosecution? The prosecution is 6 months to 7 years. So where evaded tax, where the failure to furnish the return under 139(1) or it is not only 139(1), 142(1) where the AO issues the notices, or 148, then prosecution under section 276 CC, and where evaded tax is 25 lakhs, evaded tax is greater than 25 lakhs, then it is going to be 6 months to 7 years. And less than 25 lakhs, it is going to be 3 months to 2 years. So similar to your underreporting. I think on underreporting, we have mentioned it income, but it should be tax. If tax on underreporting income, this should not be underreporting income, but it should be tax on underreported income. Clear? The 276 CC. Now there is an exception to this, and what is the exception? The exception is that if the return of income is furnished before the expiry of the assessment year, if ROI furnished before expiry of the assessment year, if the ROI is furnished, say not within the time limit of 139(1), but if it is furnished before the expiry of the assessment year, then no prosecution. Then in that case, there is no prosecution. So in that case, there will not be any prosecution. Second, if say for example, if ROI is furnished after the expiry of assessment year, if the ROI is furnished after the expiry of the assessment year, but in that case, if the assessee is other than company, if the assessee is other than a company, then the tax on the regular assessment is, then the tax which is there on income assessed under section 143(3) on the regular assessment less TDS, TCS, less advance tax, less SA tax, less SA tax paid before the expiry of assessment year, paid before assessment year. So this tax amount is less than rupees 10k, then no prosecution. So if the return of income is filed before the expiry of assessment year, then no prosecution. If it is filed after the expiry of assessment year, but if the assessee is other than a company and if the tax paid on the assessed income reduced by TDS, TCS, advance tax, SA tax is less than the 10,000, then there is no prosecution. And in case of company, if it is a company, then if it is paid, if the return is filed after the expiry of assessment year, then there will be prosecution. So this is only for other than a company, 10,000 limit is there. Is that clear? Is that clear? Any doubt? Okay. So shall we take a small break of 10 minutes and then we get back? Let's take a small break of 10 minutes. Okay. Namita, if the ROI is filed before expiry, as I said, there is no prosecution in that particular case. I have already written it in my chart. Okay. Let's proceed further then. So let me take you to more prosecutions which are given for the syllabus. Then there is willful failure to produce accounts and documents under 142.1, 142.2a. So if you do not produce accounts, if you do not go for special audits, then prosecution could be up to 1 year. So if a question is asked regarding non-compliance of notice, then you can write that there can also be a prosecution. So as you have done, there is a penalty also for that. We just did it some time back, right? That there is also a penalty in case the assessee does not give the books of accounts, does not comply with the notice under 142.1 or 142.2a, then in that case, there can be a prosecution also. So here you can just write it down, plus prosecution of 1 year. So you can write in your exam that this could also result in prosecution. Or for example, where you give the false statements. If you give the false statements and if the evaded tax exceeds 25 lakhs, then 6 months to 7 years is the prosecution. And in other cases, it could be 3 months to 2 years. Is that clear? Is that clear? Then with respect to falsification of books of accounts to induce or abet any person to evade any tax, penalty or interest which is chargeable or imposable under the Act. So if there is falsification of the books or documents to induce any person to evade tax. So if a person is evading any person to evade any taxes, then in that case, there can be imprisonment of 3 months to 2 years. Is that clear? And plus there could also be a fine. There can also be the fine and there can be imprisonment of 3 months to 12 years. 2 years. Right? And it is not necessary to prove that the other person has actually evaded any tax, penalty or interest for the purpose of establishing the charge under this section. Is that clear? Also, if there is any abatement for the false return. So if a person has abated some false return, then in that case, if the evaded tax exceeds rupees 25 lakhs, if the evaded tax exceeds rupees 25 lakhs, then in that case, it can be the prosecution again can be same, which is 6 months to 7 years. Which can be 6 months to 7 years. So wherever the prosecution is more than rupees 25 lakhs, if you see the tax, if the evaded tax is more than rupees 25 lakhs, the prosecution is generally 6 months to 7 years. Is that clear? And in other cases, it is 3 months to 2 years. So even for underreporting of tax, this was same. For willful abatement, it is same for the false return. And even for the other cases also we saw it is same. That wherever the tax is 25 lakhs, it is 6 months to 7 years. So this will help you remembering easily. Is that clear? Then in other cases, it is 3 months to 2 years. And if there are second and subsequent offences, then it is 6 months to 7 years. Then 280 is for the public servants. If they contravene the provisions of the income tax, it is 6 months. So you have to remember only these many, what I discussed so far with you, which is you can mark also in your module. One is with the search cases. This is not very important. What are very important are failure to pay the tax, TDS, failure to pay the TDS, then underreporting of income, failure to furnish the return of income under 276cc, failure to produce accounts under 142(1). So these are the most important ones which you have to remember. Any doubt? Any particular doubt? Okay, let's proceed further then. So this is about the prosecution which are there. This also, as I told you, that if it's a company, there is director or the secretary which are charged for that. And in case of firm, it is partner. In case of AOP, it is the members who will be responsible and who will be prosecuted. Is that clear? Now, with regard to the presumption, with regard to assets and books of accounts. So similar to under section 132, if you remember under 132, there was a presumption created that whosoever is having the possession of the accounts or the valuable article will be presumed that he is the owner of those particular valuables or the books of accounts, or the contents of books of accounts are true. Similar presumption is there under 278D, which provides that where during the course of the search, any valuable article or books of accounts are found in possession of any person, and such books of accounts are then tendered as an evidence during prosecution against such person, then it will be presumed that these books of accounts or the valuable which are there in the possession of a particular person at a time of search belong to that person, and the content of the books of accounts are true. Similar is in the case of the requisition also. And if it is for the assessee to disprove this particular presumption, to rebut this presumption by bringing the necessary evidence. Is that clear? Next is presumption as to the culpable mental state. Now, what do we mean by this? So, in prosecution cases, there is something called as a principle of mens rea. I'll tell you the spelling. There is this principle under the prosecution, mens rea, that is existence of guilty mind. So remember one thing, in prosecution, the provisions of the CRPC, Criminal Procedure Code, applies, and this principle comes from there. Now, what is mens rea? Mens rea is the presence of a guilty mind. So it is presumed in the prosecution cases that the particular person who has committed an offense, he had the willingness to commit that offense. The court will presume that yes, the person had that guilty mind, had that guilty mental state, and it will be for that person to prove that he had no such guilty intention. He had no such intention to commit the offense. At the first place, there will be a presumption created that yes, whosoever has committed an offense, he has committed with that guilty mind. He wanted to commit that offense, and it is for the accused or the person to disapprove that presumption that he had no such guilty intention. Is that clear? So all these prosecution cases are criminal in nature, because here you are liable for the criminal proceedings. So there is a difference between civil proceedings and criminal proceedings. Until the penalties, you are under the civil proceedings. So Code of Civil Procedure applies. But when you are prosecuted, then the criminal proceedings kick in. So therefore, there is a presumption created under the Act that the person who has committed an offense he had certain intention of committing that offense. And the burden of proof is on the assessee to rebut that particular presumption, which is called, this particular culpable mental state is also called as mens rea. And the court will presume the existence of the mens rea, that the assessee had deliberately committed this offense. Is that clear? Did you understand this particular point? Yes, Akshay, 278 could be any person who obligated for false return. It could be consultant, it could be CA, anybody. Clear? Now, prosecution has to be instituted at the authority or with the approval of the principal chief commissioner or principal commissioner or CIT or CCIT. These can be initiated because these are very rigorous imprisonment. So these have to be initiated only after the sanction of the higher authorities. Is that clear? The prosecution cannot be instituted under 276C. 276C or 277 cannot be instituted. So 276C was in regard to 276C was where there is underreporting of income, right? Or 277 was in respect of false statement and verification. So when there is underreporting of income, the prosecution cannot be instituted if the penalty is waived off. So where the penalty has been waived, then in that case, the prosecution cannot be instituted. So in these cases, you can write here, prosecution cannot be instituted if penalty is waived off. Is that clear? So if the penalty is waived off, then in that case, the prosecution cannot be instituted. Clear? Also, there is a concept of, so it has to be, sorry, the waive off has to be under this particular section, which is 273A. So where the prosecution, this has to be under 273A. If the penalty has been waived off under 273A, then only the prosecution cannot be instituted. So it is not for 270AA, but it is for 273AA. Clear? So this is for only if it is waived off under 270A, then there is no provision like that, but this is for 273A. Clear? Also, there is a provision called compounding of offences. Now, what is compounding of offences? Compounding of offence means that penalty in lieu of or fine in lieu of the prosecution. So, if an offence has been committed for which a prosecution is there, before the institution of the prosecution proceeding, the assessee can make an application for the compounding of offence. Compounding of offence means the assessee will agree that I'll pay the fine and penalties rather than getting prosecuted or going to jail. So that is fine in lieu of prosecution. Clear? So compounding of offence is possible before the commencement of the prosecution proceeding or even after that. Is that clear? Again, there is going to be a faceless prosecution scheme which is going to come in. Clear? Is that clear? Any doubt till now? Any doubt? Also, understand now one thing very clearly. All these prosecution cases which are there, for that a special court can be constituted, so prosecution are not tried before the general courts. They are tried before the court of magistrate. So a special court can be constituted for trying an offence punishable under the Act. So these particular offences are tried before the magistrate under the Code of Criminal Procedure, and therefore the special courts can be constituted for that. And then the Code of Criminal Procedure will be applicable in those cases. The Code of Criminal Procedure will be applicable in those cases. Is that clear? Also understand one thing. There are certain offences which are called as non-cognizable offence. Which are called as non-cognizable offence. Now, what is a non-cognizable offence? Non-cognizable offence is an offence where the police officer has no authority to arrest without a warrant. So, which are the cases, which are the prosecution cases in which the police cannot arrest without warrant? It is especially in the case of 276 CC, which is failure to furnish return of income. 276B, which is failure to failure to pay the TDS or TCS. 276B, 276CC. In these cases, the police cannot arrest without the warrant. Is that clear? Even for that matter, 277, false statements and verification and abatement of false return. In all these cases, there is a warrant needed to arrest. So there are cognizable, there are non-cognizable cases. Non-cognizable cases are the cases where the police cannot arrest without the warrant. In other cases, the police can arrest even without the warrant. Clear? Any doubt? Any doubt? Yes, Geeta, you are correct. In culpable state, accused himself has to prove that he has not done intentionally wrong. That's clear, correct. Okay. So we are done with the prosecution chapter also. Few case laws which are given in your module. So there's one case which is of Madhya Pradesh High Court which says that can prosecution be instituted under section 276CC, which was failure to file return of income, where the failure to furnish the return is not willful. So the court has held that 276CC prosecution will get attracted only when there is a willful delay in filing the return. So if there is a general delay and not a deliberate delay to file the return, then there is no question of prosecution. The prosecution only will get attracted when there is a deliberate intention to not file the return of income. If there are justified grounds in delay in furnishing the return, there is no question of prosecution under 276CC. Is that clear? Next is the Karnataka High Court decision, wherein there was a question before the court was, can prosecution be launched in every case where the undisclosed income or unaccounted transactions are observed during the search, irrespective of whether there is a liability to pay tax, penalty or interest? Again, in this case, the court said that there has to be a willful attempt to evade any tax. So there has to be a willful attempt to evade any tax. The assessee should have willfully committed an offense. So every unaccounted transaction would not lead to imposition of tax, penalty or interest. Therefore, unless and until it is observed that these undisclosed income or unaccounted transactions were liable for tax or penalties, the prosecution cannot be launched in these cases. Is that clear? The prosecution cannot be launched in these cases. Any doubt? Any doubt? Okay. One question before we move to the next topic, which you have to tell me the answer for that from your module. The question number 2, AO lodged a complaint against Measures KLM, a firm under 276cc, for failure to furnish return of income within the due date. The tax payable as reduced by advance tax and TDS was 60,000. Appeal filed by the firm against the order of assessment was allowed by CITA. AO passed an order giving effect to the order of CITA. Tax payable by the firm as per the said order of AO was 8,900. AO has accepted the order of CITA and has not preferred an appeal against it to the Income Tax Appellate Tribunal. Firm desires to know the maintainability of prosecution proceedings in the facts and circumstances of case. So what has AO done? AO had first assessed the income and the tax was 60,000. Assessee went in appeal. The tax was reduced to 8,900. AO gave effect to the order of the CITA. AO agreed to the order of CITA, gave effect, and the tax was reduced to 8,900. So can prosecution be initiated in this scenario? So originally it was 60,000, now it is 8,900. Appeal has to be done, Akshay, by the assessee himself and not by anyone else. Namita, application is required for compounding of offense. You can go before AO and plead that, look, there is no need of prosecution, that offense is not that grave. I have not committed intentionally. So I can just pay the penalty and get out of prosecution. Namita, 279B is nothing but that all the entries which are there with the income tax authority, all the books of accounts which are there before the income tax authority, they can be taken as an evidence for instituting the prosecution proceedings, nothing else. What will be the answer in this case? Also, the question asks you, would your answer change if the person against whom complaint was lodged was a firm instead of company? Give me the answers very quickly. Yes, Akshay, correct. Yes, Geeta, correct. Very quickly, this is not a very difficult question. Okay. Understand one thing. In this case, the prosecution will not be instituted because the tax amount is less than 10,000. Though the earlier order was 60,000, but now it has been reduced to 8,900. And therefore, in that case, the prosecution cannot be instituted. But this is a case if it is a firm. If it is a case of company, then what I told you is the prosecution can be instituted. So what we have seen so far is that if it is a case of the company, KLM is a company, then in that case, the prosecution can be instituted. If it is a firm, only in that case, the prosecution cannot be instituted if it is less than rupees 10,000. Is that clear? So if it is a company, then the prosecution can still be initiated. Very clear? Yes, Geeta, correct. Namita, yes, correct. Okay, now the last part, which are the miscellaneous provision. What we are going to talk about now is the liability in the special cases. There's a chapter called as liability in special cases, which is a very small chapter. So what are the liability in special cases? Let's try and understand. So there is something called as legal representative or legal heir, right? And the representative assessee. Now, when the assessee dies, then in that case, there is his legal representative who is going to be there, right? So if it's a legal representative, then that legal representative becomes liable. That legal representative becomes liable for the assessee who has died. That is what we are going to talk about. And then there are for certain assessees, they himself, if they are not assessable, their agents are assessed on their behalf. So legal representative is a person who is the representative of the deceased, the estate of the deceased. So legal representative is one, if the person has died, the estate has devolved on him. Right? Now, for the purpose of the income tax, what do they say is that the legal representative is liable to pay the tax which the deceased would have been liable to pay in the same manner and to the same extent. So the liability of the legal representative would be there if the deceased has died. Then the legal representative would be liable to pay the tax. Also, what they say is that proceedings, assessment proceedings which have started on the deceased now will be deemed to be taken against the legal representative. The proceedings, the assessment proceedings will continue from the stage at which the deceased was being assessed. So it will not that the assessment proceedings will stop if the deceased is no more now. The legal representative, on him the assessment proceedings will continue from that stage itself. And it will be initiated in the same manner as it would have been made on the deceased person. So there is nothing in law that if a person has died, the assessment proceedings cannot be taken against him. It can very well be done on the legal representative. Is that clear? So irrespective of the fact that whether assessment proceedings have started or they were going on before the death of the deceased, then in that case, the assessment of the income will be done in the hands of the legal representative. And all the assessment proceeding taken against the deceased before his death will be continued on the legal representative. And even new proceedings can be initiated against the legal representative. So if, say, for example, the deceased has died and he had not furnished return of income under 139(1) because he died. Or if a notice was issued to him under 142(1) or 148 to furnish return of income, but he couldn't do it, the AO will issue the notice to the legal representative that he is the legal representative and the assessment proceedings will start on him, and then will assess the income of the deceased in the hands of the legal representative as if the legal representative himself is the assessee. And the legal representative cannot deny all these particular notices. He has to comply with the notices. Is that clear? Even under 147, if the income has escaped assessment, it will be done in the hands of the legal representative. Clear? Is that clear? Then Penalty proceedings also can be taken on the legal representative. If they could have been taken on the deceased for a default committed by deceased, the penalty proceedings can be started on the legal representative also. Is that clear? Is that clear? So for the legal representative, when a person dies, all the income will be assessed in the hands of the legal representative. The assessment will happen in the hands of the legal representative. Is that clear? Any doubt? Now, what is the liability of the legal representative? The liability of the legal representative is that the legal representative will only be liable for the up to the estate which he has bequeathed from the deceased. The liability under the income tax cannot exceed more than that. So if, say, for example, he has received the property from the deceased of, say, rupees 10 lakh, and there is an income tax liability of, say, 1 CR, the liability can be only restricted up to the estate of the deceased. The liability is limited only to the extent to which the estate of the deceased is capable of meeting the liability. However, if the legal representative tries to sell the property, or it obtains a loan against that by creating a charge, then the personal liability will be there of the deceased, but again the personal liability will be limited to the value of the assets. So say, for example, if the legal representative sold the property of 10 lakhs, then he will have to pay 10 lakhs from his own account. But the liability will be only up to rupees 10 lakh, which is the value of the asset which he had received in the estate. It cannot be more than that. And this personal liability is also in respect only of tax and not in respect of penalty, fine or interest. Is that clear? Is that clear? Any doubt? Okay. Second one is the representative assessee. So this is if there is a death happening, then it is going to be legal representative. Then the second case is of the representative assessee. Now, representative assessee are different from the legal representative. Legal representative is basically the one who is legally inheriting the estate from the deceased. Representative assessee is created by the law, a person who is going to represent the other assessee. So legal representative and representative assessee are not the one and the same. So the representative assessee means that the person who are liable to be assessed on behalf of the other person because of their association with that other person. That is the meaning of the representative assessee. For example, under the trust, in the case of trust, the trustee is the representative assessee. The trustee is the representative assessee. In case of the minor, the guardian is the representative assessee. In case of a person who is not with a stable mind, the guardian or manager of that person is the representative assessee. In case of a non-resident, now this is very, very important. In case of a non-resident who has the income which is deemed to accrue or arise in India, the agent of the non-resident in India is the representative assessee. Now, who is an agent of the non-resident? Who is the representative assessee? Agent of the non-resident. And who is the agent of the non-resident? person, let's write employee of the non-resident. Employee of the non-resident. Person who has business connection with non-resident. Trustee of non-resident. Person, resident or another non-resident who has acquired capital asset in India on transfer. And the last one, from or through whom non-resident is in receipt of income, directly on or indirectly. So employee, trustee, person who has business connection, person who has acquired the capital asset, or from whom the non-resident is in respect of receipt of the income. In case of minor or lunatic, it is the guardian or manager. In case of trust, it is the trustee. So these are the representative assessee. Is that clear? For the legal representative, I'll give the points. This you can just refer on your last day also. So legal representative is liable to pay tax or the sum. Let's write the sum because it could include tax, interest, penalty, which the deceased would have been liable to pay in same manner and to same extent. Proceedings, or let's write assessment proceedings. Assessment proceedings, whether initiated on deceased or not, can be initiated against the legal representative. In the same manner, as they would have been initiated on deceased. Liability of legal representative limited to estate of deceased. In case he creates charge or disposes, he shall have personal liability limited to the value of estate. But personal liability restricted to tax and not interest and penalty. Is that clear? Clear? Any doubt till now? No, Namita, the presumption of mens rea cannot be transferred to legal representative because how can he be guilty for the deceased, right? Is that clear? With respect to Insolvency Act, the official assignee is considered as the representative assessee because in case of insolvency, the assignee is there who realizes the property of the insolvent and allocate it to the creditors. So, in case of insolvency, there is a CBDT circular, recent one. In case of insolvency, the representative assessee is official assignee. And remember one thing, CBDT has said that these official assignees will be treated as artificial juridical person. They will be assessed as artificial juridical person. This is a CBDT circular. Is that clear? Any doubt? They have to be treated as artificial juridical person. And they have to operate the separate PAN for each of the estate of the insolvent. Clear? So under the insolvency, the official assignee earlier was treated as the representative assessee, but now there is a CBDT circular which says that they will be treated as artificial juridical person and they will not be treated as the representative assessee. So CBDT circular says that earlier there were judgments which said that the official assignee are to be treated as the representative assessee in case of insolvency. But the CBDT circular says that they have to be treated as artificial juridical person and they will not be treated as the representative assessee. Clear? Now with respect to representative assessee, again they have the same responsibilities as if it were the income received by the assessee directly, right? So representative assessee is liable to be assessed in his own name in respect of such income, but the assessment is made in the representative capacity. The tax is levied and recovered from such assessee in the same manner and to the same extent as it would have been received, recovered from the assessee himself. So liable in, so representative assessee is liable in same manner and to same extent as the assessee. Is that clear? Is that clear? And what is the right of the representative assessee? So every representative assessee who is paying the tax, it is not about legal representative, but I am talking about now representative assessee. Legal representative, the deceased has died. In representative assessee, the representative assessee can recover the amount from the main assessee on whose behalf he has paid the tax. So he has the right to recover money from assessee or adjust the money. He has the right to recover or adjust the money or retain the money if the balance is lying with him of that other person. Is that clear? He has right to recover the money from the other person. Is that clear? So he has also the right to retain the money which is payable to the other person. And he can also obtain a certificate from the AO with regard to that. Is that clear? So representative assessee, as I told you, are there for especially the non-resident, employee, business connection, trustee, or from whom the non-resident has the income. Is that clear? Or any other person who has acquired the capital asset by means of transfer from the non-resident. In the case where it is a capital asset, where the capital asset is acquired from the non-resident, if you see in this case, it can be resident or non-resident. In all other cases, these have to be the resident only. A resident person can be treated as the agent of non-resident. In this case, it can be resident or non-resident. Clear? Is that clear? Where the transactions are carried out in the ordinary course of business through a general broker or an independent agent who does not directly deal with non-resident but deals with a non-resident broker. So the non-resident broker is there, there is a non-resident, then there is another non-resident broker, then there is a resident broker. And this resident broker is dealing in the ordinary course of business. Then he cannot be treated as an agent in respect of the income arising to the non-resident. Is that clear? So where there is a bona fide transaction taking place through a broker acting for another broker who is a non-resident, the Indian broker cannot be treated as an agent of the non-resident. Is that clear? Is that clear? And the person to whom the AO treats as an agent of non-resident, he will get an opportunity of being heard. Any doubt till now? Any doubt? Also, in the case of the deceased, there are legal representatives to whom the estate gets devolved on them legally, who are the legal heirs generally. Also, there are executors and administrators. So, executors are appointed specifically to carry out the will or to execute the will of the deceased or to administer his estate. So, legal representative is by law, the legal heir. Whereas executors are appointed to administer the will of the or to carry out the instructions of the will of the deceased. And the administrator is appointed by the court. If there is no executor appointed in the will, executor can be appointed through a will also. The individual who makes the will, the deceased who has made the will. Now, in case of executor who have been appointed, in that case also the assessment can be made on the executor. The assessment can be made on the executor. So what happens generally is when a person dies, if there is legal representative only, there is no executor, then the assessment will be made on legal representative. But if there is a legal representative as well as an executor, quite possible that a person had the legal representative as well as the executor, then in that case, up to the date of death, it will be in the hands of the executor, and from that afterwards, up to the date of death, it will be in the hands of the legal representative. So if a person has say died in September and he has a legal representative as well as the executor, quite possible, right? So up to the date of death, it will be in the hands of the legal representative. So income of the estate from the death to the accounting year will be in the hands of the executor. If there are two persons, so up to the date of death, so April to September will be in the hands of legal representative, and up to March, it will be in the hands of executor. Is that clear? So quite possible there are both executor also and legal representative also. Any doubt? And the residential status of the executor will be based on the residential status of the deceased person. Clear? So executor will only come into picture after the death of the deceased. Before that, whatever the period is there, that will be in the hands of the legal representative. Any doubt? Okay. So this is about the liabilities in special cases. Rest all of that we have discussed in the separate topics also. Retaining Akshay means that if he has to pay some amounts to the non-resident, he can retain with himself and not pay them. Yes, Namita, yes, that's correct. He can recover for his services. Namita, it will, how will it include prosecution? You cannot prosecute the legal representative, right? Namita, where you are wanting me to explain about representative, associate or legal representative? Shall we proceed further? Okay, let's proceed further then. There are few more things which I would like to discuss now after executors and administrators. Liability of the successor to the business in respect of tax chargeable from the predecessor. So, in case where a person is carrying on the business is succeeded by another person. So, if the business is taken over by another person who now continues that business, both the successor and the predecessor shall be assessed in respect of the actual share to which they are separately entitled. So the predecessor would be assessable in respect of the income up to the date of succession, while the successor would be assessable after the succession. So it will not be the case that assessment will be only made on the successor. It will be made partially on the predecessor for the period up to the date of succession, and after that the successor will be responsible. So the income will be apportioned between the predecessor and the successor with their shares. And both will be allowed to separate deductions, allowances, and assessment will also be made distinctly. Where the predecessor cannot be found. So if the predecessor cannot be found, say for example, he is missing, then the assessment of the income in which the succession took place up to the date of succession and 1 year preceding to the date of succession will be made on the successor in the same manner as if it would have been made on the predecessor. So where the predecessor cannot be found, in that case it will be made on the successor, the income of that year as well as of 1 year prior. And if the assessment has been made on, say, predecessor, then the sum payable in pursuance of the assessment if it cannot be recovered from the predecessor. So if the assessment has already been made, but the sum which is payable cannot be recovered from the predecessor, then the sum payable by the predecessor shall be payable by the successor. So if either the assessment cannot be made on it, or if he is not paying the sum, then the successor will be entitled to pay that sum. and the successor can recover the amount from the predecessor. Is that clear? So now this predecessor, if it cannot only be found or if he's not paying the sum, then only the income of that year plus 1 year prior can be recovered from the successor. And the successor's liability to tax also include the capital gains as a result of succession. So any capital gains which are arising to the predecessor from transfer of business, that also can be recovered on this particular income. Is that clear? From the successor. Is that clear? Any doubt? Representative assessee, which chart, Namrata? This one? This is agent of non-resident, employee, person who has business connection, trustee, person who has acquired capital asset from non-resident, or from or through whom non-resident is in receipt of the income. Namrata, assessee is alive in this case, right? You are saying that the assessee is alive. How the assessment is made on legal representative? So the assessment will be made after the assessee has died. Though he was alive, but now the assessment will not be made between April to September. Assessment will be made after March only, right? Assessment year is going to be after March. So for the period April to September, legal representative will be liable. After that, executor will earned in previous year is assessed in following AY. There are exceptions to this. And what are the exceptions? Shipping business. In case of shipping business, section 172, which requires that before a ship leaves, the income is assessed in the same previous year. So when a ship leaves, at that particular point in time, they have to take a certificate before the ship is leaving. So the income will be assessed in the same particular assessment year. It will not be assessed in the next assessment year. So say for example, the ship is there. This is shipping business of non-resident. So say for example, there is previous year 21-22. So the income of this shipping company will be assessed in this particular year only. It will not be assessed in AY 22-23. Because nobody knows whether the ship will come back or not. And then it will be very difficult to recover. So 172 requires the shipping business of the non-resident. They require that when before the ship is leaving, they need to obtain the certificate, and the levy and the recovery of the tax will be in the same particular year. So before the departure of ship from the port in India, the master of the ship has to prepare and furnish to the AO a return of the full amount of tax paid or the amount of the carriage which is payable and the tax thereon. And the assessing officer will require the ship master to furnish the return of income before the departure of the ship. And then only he will give the certificate. So they will make the payment of tax, they will file the return of income, and then the AO will give the certificate, and then only the ship can leave. Is that clear? Any doubt? Any doubt? So here, remember one thing. The profits are 7.5% of amount paid or payable on carriage of amount paid or payable on carriage of the ship or the carriage of passengers, livestock, goods mail. Is that clear? So 7.5% of the amount paid or payable on account of the carriage, that is deemed to be the income. So this is your income, and the tax will be 40% on the foreign company. Is that clear? Tax will be 40% on the foreign company. Is that clear? Then second category of income, where it is taxed or assessed in the same year, which is in the case of person leaving India. So these are generally the cases where the income tax department is cautious so that before they leave India, the taxes are assessed. So where the AO feels that if any individual is leaving India during the financial year or before its or shortly after its expiry, and that individual has no intention of returning to India, then the AO may assess his total income for the particular financial year before the expiry of that year itself. So AO may assess his income for that particular financial year, and that particular income will be assessed in the same year itself. Is that clear? That particular income will be assessed in the same year. The AO can estimate the income where his income cannot be easily determined. Clear? Is that clear? Any doubt? Next is AOP formed for a particular purpose or event. So if the AOP is formed for a particular purpose or event, then in that case, what happens that the AOPs are likely to be dissolved in the assessment year. And the AO can then make the assessment. So there are AOPs which are formed for a particular venture only, and they could get dissolved after that venture is over. So the AO can make an assessment from the earlier previous year up to the date of dissolution in the same manner as we make the assessment for the individuals who are leaving India also. Next is person likely to transfer property to avoid tax. So if there is any person who is likely to transfer the property to avoid tax, if the AO has any apprehension that the person will sell off the property with a view to avoiding tax, then he can assess in the same particular previous year itself. Last is discontinuance of business or profession. So where a particular business is likely to be discontinued, then the assessment can be made in the same year where the business is getting discontinued. So in the year in which the profits are earned, up to the date of discontinuance, the assessment can be made. Clear? Is that clear? Any doubt? Any doubt? So where the business is dissolved or business is discontinued. So where a business is carried on, say, especially by association of persons, has now been dissolved or discontinued, the AO is bound to make the assessment on the AOP itself. The AOP only will be assessed even if it is dissolved. It will be assessed in a way that the discontinuance had not taken place. So every person who was a member before the dissolution and the legal representative of any deceased member shall be jointly and severally liable for the amount of tax, penalty or interest. Is that clear? And say for example, after discontinuance, any assessment proceedings is going to get continued, then the proceeding may be continued against the member of the AOP or the legal representative of any deceased member, and the liability of the legal representative of the deceased member, but will be limited to the estate of the member. Is that clear? Is that clear? So if, say for example, any AOP is discontinued, then after that the assessment can be made on the members also. Clear? Last one thing before we close this chapter is the liquidation of the company. So liquidator of the company has to give the notice of its appointment to the income tax officer. If he doesn't give, we saw there is going to be a prosecution also. We saw that, right? And the assessing officer is bound for calling off any information. He can call any information from the liquidator for the purpose of determining the tax which is payable by the company. The liquidator cannot part away the assets. The liquidator is debarred from disposing of or parting with any assets of the company until he is notified by the assessing officer of the amount which will be sufficient to provide for any tax. So he cannot dispose of any property, cannot part away the assets without the approval of the AO. However, there is an exception to this, that this will not be applicable if the company has paid the tax, if the company has paid to the creditors, if the company has already met the cost of winding up as per the opinion of the principal commissioner. And as I said, if he fails to give his appointment notice, or if he fails to set aside any amount for the tax liability, then he will be personally liable, and to the extent of that amount, and plus there will be prosecution also. There will be prosecution also. Is that clear? With respect to the private companies, as I said, the directors are liable for the private company jointly and severally. In case of partners of the firm, the partners of the firm are liable jointly and severally. But the directors, if they prove that the neglect was not on their part, so if they can prove that the non-recovery of tax is not attributable to any negligence on their part, then the liability cannot be imposed on the directors of the company. Is that clear? But this is not the case with the partners. So partners are also jointly and severally liable. In case of HUF, the members are jointly and severally liable. In case of AOP, again the members are jointly and severally liable. Is that clear? Any doubt? Any doubt if you have? Any doubts if you have, we can take it up before we close the session. Otherwise, I have completely dealt with all the provisions. If you want to ask any questions, you can feel free to ask me. Now we'll be directly meeting up for the transfer pricing class, which is I think commencing from 14th of February. Any questions, any doubts? Namita, 164 is part of trust taxation and that would have already been covered there, right? That is a huge topic in itself. That is for the discretionary trust. Any other doubt if you have? So you guys would have done right 164 at the time of the trust taxation. Isn't it? Because I think your trust taxation chapter is already over. Thank you, Geeta. Any doubts? If you have, before we close off the session, I'm just waiting for you. You can also ask me later on also if you have any doubt with respect to any topic. You have a lot of time till 14th. We'll be again getting back on 14th. Right? Okay. So if there are no further doubts, we can just close this session.